Hello, everyone, and welcome back. It's been a pretty crazy couple of weeks in the market since we last spoke. With all the geopolitical issues going on, does the U.S. take Greenland? Do they not take Greenland? Do we use force? Do we put tariffs? So very interesting week and a lot of volatility in the markets. I'm really excited about today's session. We're going to move beyond just daily price action to focus on the bigger picture. And I believe in any kind of portfolio management or trading, you should always start with the big picture and move down to your trading style, as a result of what's happening on the bigger side. And we're going to talk about crypto versus traditional finance instead of looking at crypto in isolation. And I want to zoom out and show you how it compares to the US dollar, gold, and stocks. More importantly, we'll discuss how these assets can actually work together to build a stronger portfolio. As we go, feel free to drop your questions in the chat as usual. I'll save time for a Q&A near the end and answer as many as I can. And here's some key insights I want to share with you. In the roles of what Bitcoin and what stablecoin play as a role in your portfolio. Bitcoin's the beta, the measurement against what you do, and then stablecoins is cash 2.0. And stablecoins are great, and it's a more stable environment, and it's also a good place to invest into. As a hedge against the fiat currency, but longer term, it is also susceptible to declines and decreased purchasing power. And then cycle-based performance, correlations across rate regimes. We've talked about this before, where markets don't go in one direction. They don't simply go up and they don't simply go down. There's cycles. Sometimes these cycles are very short-lived, maybe a week, and other cycles, the longer-term trends can play out over several years. And so there's correlations with your investments across the different rate regimes. I'm talking about interest rate regimes. And, if you've seen over the last 2 or 3 years, we went from the U.S. went from a rate decreasing to rate increasing as inflation hit up. And now, maybe the Fed is done with interest rates, not sure. But you can see that it's been a big driver of the activity that's happened. So every interest rate regime causes some impact over the long term on your portfolio. And some assets in your portfolio that if the rates are rising will do well. If the rates are decreasing, other pieces of your portfolio do better. And you want to rebalance by risk rules, drawdown limits, target yields. You want to set up your risk criteria by sticking to rules that you stick to, because trading tends to be very emotional. And if you let your emotions get in, you tend to make bad decisions. So it's always good to have these rules set up. And these aren't, hard and fast rules. They're points where you have to start thinking about selling. These are your target yields, your drawdown limits. How far are you going to let a position fall? But you need to set those up based on your personality. The personality, some people are very risk averse and other people love risk. And depending, you have to set up your rules based upon your own personality, because if you say, okay, this is the best textbook example of setting rules, I'm going to use that because I'll make more money. But what tends to happen is if you get uncomfortable, you start making decisions that are more in line with your personality rather than decisions based on your rules. So it's a very hard thing to do to set up risk rules counter to who you are as a person. The best way is, you don't like risk, okay, you take minimal risk. You love risk, okay, you're very comfortable. So you'll under pressure, you'll act in a more constructive way. And you're looking to try to have true diversification, crypto plus gold plus T-bills to dampen volatility. Now, most people think everything is this is called a hedge, and some of you may know that. But a hedge basically is something goes up in an environment, a particular type of environment, and the other pieces of your portfolio may drop, and then vice versa. So you want to dampen volatility, but to dampen volatility, it comes at a cost. Most people think it's a one-to-one hedge. The value of one of my assets goes up $1, then the value of my other asset goes down $1, and so I'm protected. It doesn't work that way. There are very few direct hedges. Basically, you get some protection, more than if you didn't have that protection, and it also dampens the volatility. Now, this is very similar to, let's say, insurance. Okay, insurance on your house, insurance on your car, whatever it may be. Every month you have to pay insurance fees, and you're ensuring that if the need ever arises, that insurance will help you. So if you have a car accident, your house burns down, God forbid, then the insurance will pay off. But it could go years without ever having to use your insurance. So it's an insurance policy. And that's very similar to diversification. It costs you some money to put in there. So your total returns might be less than if you were 100% into one asset. But the risk of being in 100% in an asset is that it doesn't work out and you lose everything. So the idea is that you want to capture consistent returns over a long period of time. Now, if you're just a trader or short-term volatility trader, that's a whole different strategy. But when you're talking about long-term and middle-term length portfolios, you want to hedge yourself against possible scenarios that could pop up on the macro level. And so let's say, for example, I have $100 and I throw $100 into Bitcoin, and Bitcoin goes up, a huge amount. I make a lot of money. But let's say I put $100 into Bitcoin and it drops and continues to drop, then I have a good chance of losing a large percentage of my investment. So a hedge basically will put you in a position that if that asset drops, my other assets will go up. So net, when they're all combined together, my $100 valuation, which may be split between crypto, gold, and treasury bills, allows me to protect my downside. And so instead of losing $100, maybe I only lose $10 or $15. And then when things turn around and things go back up, I can capture my returns on the upside. So it's a very interesting way that people, they think of hedge as, okay, I buy this and I'm 100% protected, and it doesn't work that way at all. So I just want you to be aware that these things are not, guaranteed, right? And the idea is to protect your downside and still make money through any environment, whether that's inflation, stagflation, and the idea is to make money consistently over a long period of time. I want to add drops of water to the glass. I want to always be filling my cup. Some years it's not as much, but I'm still adding every year. And the value of that over a long, consistent period of time adds up very quickly. You may think you want to make a lot of money today, but long-term portfolios tend to outperform, over a 5, 10, 15-year time horizon than the trading, unless you're exceptionally good at trading. So, the valuation narrative, when it comes to crypto, you have a thing called network effects, adoption, and on-chain fees. So there's a law out there that talks about Metcalfe's law, which basically says the increased adoption increases the value, the network's value. So let's say Bitcoin or Ethereum, improving security, liquidity, and making the network more attractive to new users. So, the theory goes that as adoption increases of Bitcoin, more players, more liquidity, higher security, and fees. Now, what typically happens is fees will go up during a time of that valuation, and that's really, it's okay if they go up a little bit, but there's a point of a point called diminishing returns, where those fees actually become a deterrent. So I think the idea that the adoptive fee paradox is adoption increases equals higher fees, and but the main thing I think about crypto is the narrative. It's a narrative of the future growth and future adoption, and I think that drives the value. If you've got let's say 25% of the world using crypto, maybe that number is high, maybe it's low, I'm not sure. But if that number increases, there's going to be more players in, more money. You've got a fixed number of availability, so it's limited. And so, if demand outstrips supply, then economic theory would basically tell you that value will go up. So I think the whole true positive network effects are rare in crypto, and it's many networks face congestion effects, and so that's going to be a paradox that will continue going forward. So I just want to move on to some of the top questions from the live chat, and I want to comment on your insights, and I'll go through as many as I possibly can. And we've received some excellent insights here. Should beginners focus on crypto or start with traditional assets first? I think it doesn't. The asset classes are very similar. Trading stocks and trading crypto are very similar. Meaning that the trading philosophy, when you first start, can apply to either one. And I think you should start with the things that make you the most comfortable. If you're new to investing and you've been around crypto and you're comfortable doing that, then I would start with that. But be aware that there's a lot of volatility there. And again, that goes back to making sure that you're staying consistent with your personality. So if I'm a risk on person and I'm aggressive on getting my returns, maybe I start with crypto. If I want a little bit slower introduction into investing in financial assets, I would start with maybe the traditional assets first and get my feet wet, and then apply those slowly to the crypto side. So again, this ties right back to what I was talking about earlier about staying consistent with your personality. Everybody's different. I was a trader for many years, not in crypto, but on stocks, and was a partner in a firm where we traded. And every person in that room, we had about 40 traders, all traded different ways, and they were all obviously different people, and they were all very successful. So I recognized early on that this is something that needs to be focused on and take it very seriously. Do an honest assessment with yourself on how am I as a person. If I'm a person that's very conservative and I get into a crypto and I want to try to make more money and I lose everything, that doesn't help me. So please stay consistent with who you are and you set up the rules based on that. And question number 2, you see here is, what is one simple principle beginners should remember when combining crypto with traditional finance? So again, this goes back what we spoke about earlier is, if I'm buying crypto and then I'm also investing in traditional finance, they play different roles in my portfolio. In an allocation, how much should I allocate? Should I allocate, 50, 60% of my available cash to crypto and the other 40% to traditional finance? Should I go bigger on crypto or smaller on crypto? What percentages? So you need to figure out what percentage you would be comfortable with until you become more experienced and more comfortable with let's say crypto, and then you can increase that exposure to crypto as you move forward. So I think again, the conservative guys, you start out, maybe you only do 10% of your portfolio in crypto, and then as you get more comfortable, maybe you go up to 30 or 40%. Other people will be the opposite. They'll start out with 60 or 50% of crypto and the rest in traditional finance. So I think you as an individual trader need to determine the best allocation, distribution of how you spend money. So I put a little bit of money here, I put a little bit of money there, and a little bit of money over here. And collectively, am I getting the returns I want? And then that doesn't stay static. That changes through the year. Maybe you increase some asset classes, maybe you decrease other asset classes, really dependent upon how the macro environment looks, and also how the returns are going on for you as a year to date, and using that as a measurement. And question 3. For someone who wants less volatility, how can traditional assets help balance a crypto portfolio? Well, it's under traditional assets, let's just say stocks, let's just use stocks as an example. Stocks represent companies, and I can buy stocks, or I can buy treasury bills, or I can buy income producing assets that, instead of very large price appreciation, I can get dividends and I get some cash off. So for example, I could buy, let's think of, I'm trying to think, Alcoa or some stock that pays a large dividend. So I spend $100 and every year I get 3% dividend on that money. But the appreciation of that asset is less. It's pretty stable, but you're doing it for cash. So I think you need to balance. So if I make 3% on something with very little movement, and the other I put money into to get my asset appreciation, combined, maybe your total return is 10 or 15% based on that. But if the market goes bad, I'm still getting 3% cash all the time. So I would focus on buying things that are stable stocks, income-producing stocks, treasury bills, which pay just an interest rate, pay a coupon to you, either 1 month, 6 months, 1 year, whatever T-bills you're buying. And when you're question number 4, when this is tying into what we were just talking about, when moving from traditional investing to crypto, what mindset shift is most important for managing risk across different asset classes? And this ties right into, I may have already answered this, the mindset is you have to be prepared for the volatility, okay? And that's why if you start with traditional finance and you have a small exposure to crypto, this would allow you to get used to the volatility of that. So it's not surprising to you, and I would do it over a long cycle, not a short cycle. Maybe I'm not talking a week or 2 weeks. I'm talking 6 months to a year and a half, 2 years, something like that. And I think you need to adjust your mind, adjust your understanding that this asset is volatile, but that's the nature of that beast. Okay, so it's and if I'm prepared for that mentally, then I'm not making rash decisions and panicking if I buy something and it drops right away. Instead, what I'm doing is, okay, I buy this, it's going down, so now I want to protect my portfolio, and then I want to put my investments into more traditional that protect the downside that I know I'm going to experience with the crypto. And I think with that mindset, you could do quite well. And I think that if you do that consistently over a long period of time, that you will, number one, you'll be able to sleep at night if you're not staying up all night trading. And you also get the compounded returns, right, over a long time. People forget that if I have $1 and I lose 10%, right, when I get back to even, when I lose that 10%, I have to make more than 10% just to get back to even, right? So you have to have an exceptional environment. In crypto, it can happen quite easily, both up and down. But in more traditional stocks, if you're hedging with income producing stocks, dividend paying stocks, they very rarely drop 10% because they're protected. The stock itself is protected by the dividends that they pay. So people buy those stocks for income. They buy treasury bills for income and hedge against volatility in my more aggressive assets. And going to another question here. In periods of high inflation or economic uncertainty, how do crypto, gold, and USD usually play different roles in a portfolio? And this is a very interesting question because they each play a role, right? So correlation between crypto. Excuse me, I've been sick the last week. I've had the flu, so sorry if my voice is cracking a little bit. Crypto and stocks, basically are the high correlation between crypto basically acts like a tech stock, right? But there are all kinds of stocks that don't act like a tech stock. So there is a correlation dependent upon what stocks you're comparing crypto to. So you think about crypto, think about the movement of tech stocks, which are also very volatile. And crypto has similar volatility, but there are thousands and thousands of stocks that don't have that kind of volatility. So if you're going to, you don't want to, diversification, you can't buy crypto stocks or crypto and then also buy tech stocks and expect your portfolio to be balanced, because it won't be. You're basically on the same side of the boat. So if the crypto goes down, tech stocks will most likely go down as well. There's no protection there. And then gold and stocks, gold often acts as a hedge against stocks, and it's a safe haven, but only to a point, because if in the short term that's true, longer term gold may stay flat, especially in an environment where the interest rates are going up, and the idea is that you would buy gold, hedge yourself in an inflation environment, and protect yourself. And the other thing you can do is, you can, instead of buying gold, you can buy gold stocks. You can buy stocks that go into gold, so on. But if interest rates go up quickly, then gold tends to languish a little bit, because I can buy stocks that the currency, the US dollar, will tend to go up, because people are switching to interest-bearing deposits. If interest rates go up, then the dollar will potentially get stronger, because more I can get more return for less risk. It's a more stable environment. So I think each role that crypto plays, gold and USD, are very distinctly different. And within those different categories, you have subcategories of each one of those for that can go against that. So crypto, gold, and USD, maybe it's a different currency. Maybe under gold, instead of buying gold, you're doing stocks that trade in gold. Either they're service providers to gold, they're mining companies, instead of actually buying the asset itself. And crypto, the same thing. Maybe instead of buying crypto directly, you buy stocks that are involved in the crypto business, like Coinbase, so on. So crypto is here to stay. It's a key player in global finance and growing daily. So knowing how it fits alongside USD, gold, and stocks is crucial for any long-term investor. So I would do some research for yourself, and look at how in different environments each asset class performs. And again, there is not a perfect hedge out there. It's just important to be diversified. If I make a bet and I gamble and I put all my money onto crypto, I might be right, and I could make a lot of money very, very quickly. The other possibility is I make that same bet and crypto goes down and I lose everything. So the idea is to always be able to stay in the game and get the majority of upside on different asset classes. And so I never want to be in a position in my portfolio where I'm betting on one thing to work, because sometimes it works out, sometimes it doesn't, and could have long-lasting implications on your portfolio and on your life. So I would be very careful, cautious, to make sure that you might be making less money, less than if I invested 100% into something, but at least I'm not losing money. And again, the idea of once I lose something, it's harder to make it back. I have to make more back just to get to even. So I think diversification is really important, and the allocation of the percentage of the money that you have, it really is determined by you and your personality. So I think I think that's all I have to say today. And I thank you for tuning in and listening to this conversation. And as always, stay disciplined and invest wisely. And I hope to see you next time on our next talk. Okay. Have a good afternoon. Bye-bye.